Welcome, guys, to another market analysis video. It's Friday today, and we just continuing. This is our price development for our gold and DXY video market analysis in the previous one. So we're just going to look at how prices developed over time in the last half of the week. So we have our Wednesday, Thursday, and Friday. So what we're just going to look at, as we can see our screen, we had from price to this way we were. This way, as we were analyzing, this is where price was. And as we can see, price did go up. So what I want us to pay attention to, obviously, in these price development videos is the fact that we need to take our notes. Let's see how prices move from our narratives, from perhaps previous market analysis, what we were anticipating, what we were anticipating transpire, or did something else happen? And if something else did happen, what happened? How is it different from what we were seeing in the markets? And that's how we learn. We take our notes and then obviously develop and grow from there. So what I want to pay attention to, we had this tool that we had placed here for our low risk entry. As we were analyzing, we had said that if we're looking to enter into the markets, our low risk entry could first be there. And obviously risk to reward ratio is always a minimum. For me is a 1-3. You can obviously then look for your 1-4 and 1-5 movements, but minimum always a 1-3. And obviously from our low risk entry, what we were willing to risk at that point was that much from, let's say, entry at 21.68. So that exit would have been at 21.75, which obviously looking at now, if we had obviously entered at that price point of a low risk entry, we would have been stopped out by what we call this wick. So the wick would have done the damage and we would have been, part of the victims of that wick. But of course, looking at our previous video, the market analysis, what I had forgotten to mention was obviously this part of this Fibonacci tool. We had forgotten to do it there, but obviously after the video, when I continued the market analysis with due diligence, we did take notes of that. And what I want us to obviously, we looked at, and that candle was that CPI candle. What we did, because there was that week, which almost also in a way is kind of a gap in the market. So we obviously took it from the top, from the high to obviously the opening of that candle or of that wick. And obviously our 50% is normally where price should normally have those reactions. So we did enter into this, as we are doing the analysis, we did enter into this trade. We got our entries right there at the 50%. My first entries were there and moved with the market. Second entry was at 21.73. So I was around there. Market went down. When it came to retest again, I think I added more on this side on the 21.70. When price moved further down around this, when it just tried pushing up here, we made another third entry to then go with it all the way down and exit around there. So what I want us to obviously pay attention to is what happened. So as we were analyzing on Wednesday, we did anticipate that from this margin, we should look for market to firstly push up before we can continue with our weekly bias, which was a sell for this week, because from Monday, the market has been, from Monday, as we can see, the market accumulated a bit there. And then Tuesday, it moved down. Wednesday, Wednesday, we had that nice accumulation before the market went back up again, and then took whatever monies, that's what I normally say, took whatever monies we needed to take, reached the stations it was stationed to go or directed to go, and then we closed off again. We went down into our sell side liquidity, only to then again start rallying up. So we'll see what happens today, since we can see this nice accumulation happening again. So what I want us to pay attention to is perhaps why price went up and why price went down in just this small start, because we can see the market literally canceled itself out in those movements. So this has to be a short video, price development. So we're just going to remove this tool, which is very much key. This is why analysis, backtesting is always also important. Not to rush into the markets, always wait for markets, look and wait for confirmations, see how price is closing at certain price points, how is it reacting, and then you can make informed decisions. So from that point on, when we were analyzing on Wednesday, this nice accumulation, as anticipated, we did push up. As obviously we can see, price did push up into these margins, just for that week there, we were looking for that 50%, which we did, but we reversed at the 75. What we should pay attention are the bodies. So all the bodies are closing at that 50% margin, which we can say perhaps is an indication of sellers coming into the market, and obviously the buyers losing that momentum that they had from this accumulation. So that could have been an opportunity to enter into the markets, as well as this was an opportunity to enter into the markets. So as we went up, what did markets, after offsetting obviously from that nice bullish momentum there, after whatever monies we grabbed there, we went back down. And when we were going back down, what we need to pay attention to is where the bodies closed in all those movements. All bodies stay above that fair value gap that we had here, which is where the accumulation was happening, and which is where the buys obviously started their rally. So this is where the wicks did the damage, taking out all the liquidity that was being generated as we were obviously accumulating there. So the body, or the wick rather, the wick did the damage, and then the bodies were closing. So this is what tells the true story. It's the bodies. When the bodies closed, yeah, that could have been, this was another station to perhaps for your scalpers, your day traders. This could have been another position to obviously look for those long buys and expect that similar reaction. So from having that nice movement going to the downside, we then obviously close the bodies closed in that fair value gap. We moved up, and as we are moving up, this is where we are currently at right now. And just remove that. This is where we're currently at right now. The market is accumulating, and what we need to pay attention to is where it's accumulating. The market is accumulating in that another point of interest, that our low risk entry that we had and anticipated. So in my anticipation from this point, normally, when you are early into the market, you get stopped out and you think the market is after your stops, not, and that's not really the case. The market is doing what it's doing. So with this stops in this margin now, the market went up, it broke out, obviously broke out, retested this area a bit, and then it came back down. In its coming back down, it broke the structure again. From it being, that short-term support, then, it made that accumulation. So this was our impulse consolidation, and then the impulse again. So what we could expect here from this breakout, we could expect this to be our resistance level, and then obviously look for the continuation for the sells to obviously take our opposing liquidity, which is resting there, as well as that low at 2150, the one that we were anticipating to be taken out. But obviously we don't rely on what we want the markets to do. We observe what the market is doing, and then we wait it out. So obviously, keep this video short. We can just look at, for the trend line based traders. If you're going to connect these trend lines, we can obviously just do that. We have our 1 second touch. Right now, we could be anticipating that third touch. So it's two ways. Hence, from this place, we could, either from this point, we look for that up breakout, we go to the weekly and then create our high for this week, because our high for this week, I think, is around there. So we haven't really, and from that opening here, we've been on the downside of the market. So we've been on the discount of the market from that weekly open. So we could look, perhaps if it's today, we could look to go to the upside. If we don't, we don't. It's a Friday. Normally the arm movement's Friday because it's that last day. So we could be both sides, just like we saw on the Wednesday, whereby it went up and then accumulated there. And then on the Thursday, what happens? We go down. Cancel the market, literally just canceling itself out. So we'll see from this place what's going to happen. This perhaps, this could be an indication, since this, as we were retracing here, we didn't retrace below this low. So the market could still be in its buying, as it has been buying the past couple of days, as gold has been moving up, so being bullish. So we could expect that same narrative to continue, because it didn't break below. So we are staying, and as we know, the market has to move. We have our low there. This is our higher low. So we could now expect a higher high being created, breaking that one day. From this point, we break. And then if that happens, then that can be our confirmation for buying or the bullish momentum. But obviously, we'll have to wait and see what the market does. So it's two possibilities. Hence, this area here is a point of interest. Are we going to go to the downside, maybe look to retest here and go further up, or are we literally from this point, as we can see on our perhaps our third touch, we continue to the downside, taking out liquidity, resting on the sell side. So we'll see how price develops over time, but this is it for gold. We've seen how price has developed, and just going to take a quick peek at DXY from the moment, or maybe remember, I think we were also around these margins in the DXY in the previous video. We had just escaped this obviously this fair value gap. And I remember obviously we anticipated that price has to go to the upside. We're looking to tackle these highs that were created there, and obviously, and finally we are targeting our target. If I'm gonna remember, it was 103,400. Price had, for me, the next drawn liquidity was supposed to be 103,400, which, as we can see from that margin, what price did, it first took out this accumulation. We first had to take out that accumulation, which I would call my manipulation, the power of three. You have an accumulation, manipulation, and then our overall expansion. So from that point on, price did go down, grab just liquidity there, had to. So this was basically the market going for stops, because the market knows that people, or there's players in the market, traders, with stops resting below, obviously, our lows and whatnot. So it did, as we can look at it, obviously went there, took out that low, that created that rally there. And then as soon as it took it out, we then started going towards the upside. Nice accumulation of orders, and then we go to the upside, which is where the target was. So that's possibly the order flow was towards the upside, and we first TP was there, first target was taken at 103, 170, and then also 103, 300, second target, and finally our third target, and exiting over here. So we'll see how price develops from this point. Is price going to retest this area? And, as we can see here, there's a supply zone. Is it still going to be a supply zone, or is it now going to change and become a demand zone and obviously target more liquidity into the upside? But from obviously looking at what price did move the way we had anticipated, so we take notes from that, and why perhaps, if you had entered there, where could you have potentially placed your stops? If you had placed them just beneath that low, you would have been stopped out. You take those kind of notes. But moving forward, this is how it is. This is how prices develop. And to many more, we're going to see again next week what we're going to look into. And I hope everyone had a pleasant and trading week. God bless.